I'm gonna sneeze. All right, good. I've been involved in real estate since 2005, and I've been investing since 2009. And I remember when the market collapsed at the end of 2008, looking at different real estate investors and real estate landlords, some of them, many of them, worth tens of millions of dollars on paper, some of them going completely bankrupt, and other ones who today are worth hundreds of millions of dollars. How does the same economy happen to everybody? How does the same market collapse happen to everybody, yet some sink and some swim? What is the difference? I've done a lot of research on this, and I looked at the difference between the people who went bankrupt and the people who are worth hundreds of millions of dollars today, and what the difference was in their philosophies, their business strategies, and the types of properties that they purchased. And I put together and have designed my business around the ones that were able to survive and thrive after that market collapse. So what I'm gonna share with you right now is the risk mitigation strategies to make sure you don't get your ass handed to you during the next market cycle. All right, let's dive in. Risk mitigation strategy number one is to always buy at a wholesale price. What does that mean? It means never pay retail for anything, right? I don't pay retail for anything, especially my real estate investments. When you buy at a low enough price point, it gives you a lot of different options. It gives you a lot of different strategies on what you can do with that property if you buy at a low enough basis. The only controllable number, the only real variable in buying apartment buildings that is a controllable number is the purchase price. I see a lot of people wanting to buy apartment buildings and say, hey, it's a little bit tight, let me scale back the construction. No, that's a fixed amount. You have to make those improvements in order to get the rents that you want. And they're trying to restructure the finances on this. Or maybe, hey, instead of getting $1,000 a month, maybe I can get $1,100. And they tweak the numbers to try to make it make sense. No, the only number that should be tweaked is the purchase price of that property. Make sure you're buying at a deep discount every single time you buy an apartment building. Risk mitigation strategy number two is create appreciation through the value add process. Meaning we never speculate, right? Maybe we'll hope for appreciation, but I would never bank on natural appreciation happening. I'm gonna go in and I'm gonna create appreciation by putting sweat equity into the property. So that way I can come in, fix it all up, put good tenants in place, put good management in place, and create and force the appreciation to occur because I created the value. I put sweat equity into the property, which then makes a spread and increases the value of the property. This is why I buy almost exclusively value add apartment building deals, because I can create that appreciation. It's why I've been able to build a portfolio of $400 million over the course of the past 5 years in a smoking hot real estate market and still generate $150 million of equity in those deals. It's because I bought at a deep discount and I created appreciation through the value add process. Risk mitigation strategy number three is to always buy for cash flow. Cash flow is one of those things where it doesn't matter what's going on with the market. If this property cash flows, you can ride out any sort of economic storm. If your property cash flows, that's almost like the lowest common denominator of whether or not a deal will work. If it cash flows, you can cover all your operating expenses. If it cash flows, you can cover all your debt service. If it cash flows, you can put cash in your pocket on a monthly basis. If it cash flows, you can refinance it at your basis. You can refinance it above your basis, maybe even pull out some refi proceeds. You can sell it, you can seller finance it, you can get creative on an installment contract. You can do so many different things if the property cash flows. Because if values go to zero on paper, but this property cash flows, and I'm still putting money in my pocket and it's covering itself and paying down principal, there's still value to that. Even if values go to zero on paper, there's still value in cash flowing properties. And here's the beauty of cash flowing properties. You could screw the whole thing up. You could overpay for it. You could speculate on appreciation, but as long as it cash flows and it covers the operating expenses and it covers the debt service, even if it breaks even, and you sit on that property long enough, eventually rents will bump up and the property will appreciate. Eventually, you will pay down enough principal and you'll create a spread of equity equity built into the property where now you can sell it, now you can refinance it, now you've got different exit strategies on the deal. Cash flow is that lowest common denominator of whether or not a deal will work. So make sure that if you're buying a property, you're buying for cash flow. Risk mitigation strategy number 4 is stick to good areas, right? Like I used to buy in D-class war zones. And I've had actually some of my best returns and my worst returns in those areas. You can hit big, but you can miss big too. When I started building my properties and realizing I needed to build my portfolio, I built a lot of like C-class and B-class type of apartment buildings. I bought those types of areas and I just kept on growing my portfolio because those were easier to come by. Now, for where I am, I'm only looking for B and A-class areas. And so when I'm going out and buying apartment buildings, I'm looking for areas that are safe. I'm looking for areas that have good school districts. I'm looking for areas that have good economic indicators. Those A-class areas are kind of like the places where you desire to live. The B-class areas it's where I grew up. You know, it's a good area, safe area, but it's not really the most desirable area in town. But it's good, you know, blue collar, working force type of an area. And then the C-class areas to me are more like, I'll go there, I'll invest there, but I don't want to be there long term, right? I don't want to live there, right? But I don't want to bring my family there. But I'll go there and invest there from a business standpoint. And then D-class is like, I don't want to go there. If I had a friggin' army with me and a Kevlar vest, I don't want to go into D-class areas. I don't ever want to go there. I definitely don't want to invest there and have my wealth there. That's me personally. There's a lot of people who love D-class areas, who love C-class areas. I started out in C and D, but I eventually wanted to graduate and level up into just good longer term holds. Not necessarily because of like the social side or the economic side of things, but mostly because it's management intensive in C and D class areas. When I get into like workforce type housing, it's a very easy property to manage. These people, they can get a flat tire and it doesn't derail their finances. They go to a job, they go to work, they actually have personal responsibility to take care of the property and take care of their unit and be respectful to the other tenants. There's less turnover, there's less transientness to the tenant base coming in and leaving and all that kind of stuff. So that's why I like B-class. I also don't invest in super luxury property either. It looks nice, it's sexy, it's great for the front of a brochure or a magazine, but it doesn't make the most money, and I think there's risk in it. When the market's good, everybody can afford that middle of the road, B-class, blue collar, workforce type housing. When the market shifts, a lot of those luxury renters move into more of a B-class, A-class workforce type housing in order to save some money. So you're very insulated in that middle area right there. But if you're looking to build your portfolio, C-class, there's nothing wrong with it. I have a bunch of C-class property. It helped get me to where I am. It was a stepping stone for where I am today. It's just not where I want to be personally long term. There are some people who love managing it, who are really good at managing it. For me, my ambitions and just kind of like where my patience level is, I just want to be more into B-class, A- kind of areas, the good areas with good school districts, good safe areas with great economics to them. That's where I want to be. Risk mitigation strategy number 5. This one is to complete all due diligence. Do not skimp on due diligence. I remember early on when I was buying apartment buildings, I didn't want to spend a bunch of money in case I didn't buy the building, you know, or really probably it was an ego thing. I didn't want it to kill the deal. I didn't want to have a terrible report come back and be like, oh man, I got to walk away from this deal, because that's hard to do. I was emotionally involved in a lot of the apartment buildings early on. Now it's dollars and cents. It's dollars and decimals. It's non-emotional. It's all about, do the numbers work or do they not work? But early on, I didn't want that to kill the deal, and I didn't really want to expend the money, thousands of dollars, to have, you know, and pay contractors to scan the roof with a thermal inspection and to scope all the plumbing lines and do all these different things. Here's what I found. Because I didn't spend that money, it cost me tens of thousands and hundreds of thousands of dollars in renovations that I had to take on, unknown renovation costs, because I didn't do the due diligence on the front end. By doing the due diligence, I'm telling you, it will always pay a dividend. It will always pay a return on investment, or at least give you the peace of mind knowing you're buying something that's in good shape. I'll give you an example. I bought a 105-unit apartment building in Louisiana a little over a year ago. And on this 105 unit apartment building, we actually spent, it was $3,000 or $4,000 to scope all the plumbing lines from the building to the street for every different property building that was on the property. In doing that, we noticed that a bunch of the plumbing lines were cracked, and the plumber's like, dude, I bet this guy has like, shitter water just overflowing in his apartments on all the ground floor levels. And so we took this report, we went and got a plumber to come in and give us a not to exceed bid. And that not to exceed bid was like $72,000. So we spent $3-4 grand, but then we had $72,000 bid in order to improve the property. I'm not paying that. I expected these plumbing lines to work. So I took the $72,000 bid, we went back to the seller and said, hey man, tell me about all the plumbing issues that you're facing. Because here's what we found in the report. Here's the bid in order to fix it. What are we gonna do about this? You know what he said? You got me. Yeah, you caught me. All right. We'll drop the price by $72,000. If you've never heard this before, write it down. Buyers are liars and sellers are worse. It's 100% the case when you're buying apartment buildings. So make sure you do not skimp on due diligence. Make sure that you invest a couple $1,000s. It will be a couple $1,000s well spent. Because even if you have to walk away from the property, it's a cost of doing business. You're in the big leagues now. But it could save you hundreds of thousands, if not millions of dollars of renovation costs and carrying costs and all the other headaches that could come with it if you don't do the proper due diligence. Risk mitigation strategy number 6. On this one, what I wanted you to do is make sure that you're stress testing all the underwriting. Here's what I mean by that. Let's say you can rent an apartment for $800 to $900 a month. I see people who really want to get a deal done put the rents at $900 a month. You know what I do? As a seasoned real estate investor who's not only been doing this for a long time, but doing it at a high level for a long time, I underwrite it at $800. I might be able to get a valuation at a cap rate of 6.5%. I'm gonna put a valuation at a cap rate of 7%. Right? It inversely affects the value, which means I'm gonna put it at a lower value. I'm gonna stress test the rents. I'm gonna stress test the interest rate. I might be able to get a 3.5% interest rate right now. Maybe I'll underwrite it at 4.25% when I go to refinance it in 2 years. I'm not gonna expect interest rates to stay completely flat at historic lows. I'm gonna stress test that interest rate. I might be able to get a 75 or 80% loan to value loan in the specific area that I'm investing in when I go to refinance this property. I'm going to expect it to tighten up a little bit, and I'm gonna underwrite it at a 70 or 75% LTV loan. So I'm stress testing the numbers in many different ways to try to kill the deal. And if you stress test it in many different ways in order to try to kill the deal, and the deal still works, guess what? You got a good deal. Because God willing, you can get $900 a month in rent. God willing, interest rates do stay flat. Cap rates stay compressed. Values stay high. LTVs remain where they are at right now. If all those things happen, it takes a deal that worst case scenario was still at least a base hit and turns it into a triple, home run, or even a grand slam. So stress test the numbers across the board to try to kill the deal. And that's number 7. Number 7 is actually try to kill the deal. Because if you cannot kill the deal, that's when you know it's a really good deal. Risk mitigation strategy number 8 is to obtain favorable financing terms. When I go and acquire a property, a lot of times it's going to be a full recourse loan because it's a distressed property and we're making a bunch of renovations to it. It's a construction type loan. I got to personally guarantee it, maybe a little bit higher of an interest rate. Ideally, I try to tighten up those financing terms. And especially when I'm going to refinance the property in 12, 24, 36 months, I want to make sure I put really good long-term debt in place. And the things that I'm looking for there are a fixed interest rate. I want predictable cash flow on my properties, so that means I need predictable expenses on my properties. Debt service being one of those things. So I'm looking for a fixed interest rate. I don't want variable. You might be able to get variable at a little bit lower rate right now, but what happens when rates bump up over the next 2, 3, 4, 5, 10 years? We're at historic lows. They're only going to go in one direction, which is up. So I want to lock in a low fixed interest rate from day one. I'm also looking for non-recourse loans. Once the property is stable, you don't have to personally guarantee the loan anymore. You can get a non-recourse loan where, there's something called bad boy carve-outs where if you lie, cheat, steal, if you're grossly negligent or fraudulent, they'll come after you. But if you don't do anything wrong, and the market collapses, or a big employer in town goes out of business, and you're running the property proficiently, doing the right thing, and all of a sudden the property is not performing and it's got to go back to the bank, their only recourse against that loan is taking the property back, not coming after you personally. So whenever I can sign a non-recourse loan, that's what I'm looking for. As my net worth increases, I want that safety net to increase with it. I don't want more liability by having a bigger net worth. I want less liability with a bigger net worth. So that's one of the things that I'm doing from a non-recourse standpoint on the financing terms. Then I'm also getting a long amortization schedule. The amortization schedule is how many years, essentially the payments are divided out by. And so I'm looking for 30-year amortization schedules. Well, Tim, I don't really like debt and I want to pay off this property in 20 years instead of 30 years. Well, here's what you could do. Make one extra payment per year and you pay off that property in 23 years instead of 30 years, just by making one extra payment. That's how the numbers work out. If you want to pay it off early, you still can. You can still make additional payments on the property should you decide to pay it off early. What I don't want is for COVID-19 to happen or an economic collapse to occur, and all of a sudden things tighten up. Occupancy drops, or rents have to drop, or expenses go up. Something happens where your cash flow is adversely affected. In that scenario, I don't want this big payment every single month. So I'm not going to amortize it over 20 years. I'm going to stretch it out over 30 years. If I want to pay it down sooner, I will by making additional payments. But if the economy changes, or if for any reason I don't want to make those additional payments, I have excess cash flow and a little bit more padding, a little bit more cushion in my cash flow to ride out any sort of economic storms that might occur. And then from a financing term perspective, I'm looking for at least a 10-year term. Some of my loans have 15, some of them even have 20-year terms on them. You can get a loan that has a 30-year amortization schedule and a 30-year term, but your interest rate's gonna bump up a little bit. You can get a loan that has a 5 to 7 year term with a lower interest rate potentially, but I think there's some stress financially of where the market could be in the next 5 to 7 years. I like that 10 to 15 year term. It's kind of a sweet spot where you get a good interest rate, a long amortization schedule, and you have enough time before it balloons, the property loan balloons, where you can ride out any sort of market cycles. Meaning, think about this. If you bought a property at the peak in 2006, the last market cycle, and you had to then refinance it with just a 5-year loan in 2011, you didn't pay down enough principal on your loan. The property definitely didn't appreciate. The property values came down significantly. Interest rates, I think, came down a little bit from where they were, or maybe they stayed kind of flat. But here's what happens. You don't have enough equity built up into that property over the course of that 5-year term to then sell the property or refinance the property. But if you had a 10-year term on that loan, you bought it in 2006, you go through the greatest housing recession in the history of the country, and then by 10 years later, in 2016, values came back almost to where they were in 2006. But even more importantly, you were able to pay down some principal and chip away at the principal balance. And you were able to ride out that economic storm, values came back, principal was paid down, and you had enough equity built up where now you can refinance the property, now you can sell the property, you can get creative on your exit strategies. So make sure that you're taking a look at your financing terms and getting something that has a fixed interest rate, that has a long amortization schedule, has a good middle of the road, longer term to balloon out, and is a non-recourse loan. Those are all really important factors when you're putting your financing in place. Risk mitigation strategy number 9. This one is cashing out your investors quickly. I don't like owing people money. So when I buy an apartment building and I create the appreciation and I increase the value of these buildings, my goal is to then refinance it at a higher valuation, and the loan to value is essentially more than what I'm all into the building for. So it allows me to then pay back my investors at the time of the refinance within a few years and pull all the chips off the table. Now, when you don't owe anybody any money, you get to make the decisions. You can sit on that property for as long as you need to because you don't owe anybody their money back yet. So all the chips are off the table. It's only house money in play, meaning Freddie Mac, Fannie Mae, agency type loans, where that money's in play. It's long-term money, so you don't need to pull it off the table at any given time. All your investors are paid back. You can then recycle their money into more deals, and they're happy because they're still maintaining some equity in that first initial deal, and they're able to continue to build wealth with us the same way that we do, with property appreciating, principal pay down, depreciation and tax advantages, everything else that comes with it. So I'm trying to cycle out my investors and get them their cash back as quickly as possible for multiple reasons. I don't want their money in on this deal anymore, because that way I can make some better long-term decisions for this property. And then secondly, they get their money back and then they can recycle it into a new deal with me, and I don't have to go and raise a bunch of money. As soon as they get their money back, they're like, Tim, what's the next deal? Let's roll. Let's keep moving it forward. And then the 10th risk mitigation strategy is to have multiple exit strategies. You know what I think about here? I think about golf, and I think about a golf scramble. I'm not that good of a golfer, but in a golf scramble, I'm a pretty good team member, right? And so I'm good for one good shot per hole kind of a thing. In a golf scramble, if you're not familiar, you got 4 partners, everybody hits the ball off the tee, and you take the best ball. And then everybody moves their ball to that best ball, and then they all hit again from that location. And so you have 4 chances at taking a good shot. 4 strategies and different balls that you can then play because you got 4 different options. I think in life, the more options that you have, the better options you have, right? Like the more quantity leads to better quality. And that's a big deal with having exit strategies with apartment buildings. If you only have one exit strategy is to flip this building, you're gonna be kind of have your hands tied. But if you could flip it, if you could refinance it, if you could refinance it at the basis, maybe you can refinance it above the basis. Maybe you can get creative and do like an installment contract for deed. Maybe you can seller finance it. Maybe do like a wraparound sandwich mortgage on it. Maybe you can sell it at a retail price, sell it at a wholesale price, keep some equity in the deal, sell a portion of it. There's a lot of different exit strategies to selling apartment buildings, and the more exit strategies you have, the better quality of an exit strategy you're going to come up with. So make sure you have multiple exit strategies. You're not painting yourself into a corner where you only have one strategy, because that could end up bad, and you could end up in a really tight spot if that ends up being the case. So make sure you have a lot of different options, a lot of different strategies, and you're playing golf scramble versus only playing one ball. So that is 10 risk mitigation strategies that you can use in order to build your business the right way. So that way, during the next market cycle, if the market does take a dip, and if the market does get a little bit shaky, and if people are a little bit spooked, you have multiple exit strategies. You got a lot of different ways that you've already mitigated the risk in your business that's going to allow you to then ride out any sort of economic storm. So take these strategies, implement them in your business. If this was helpful for you, give me your favorite one, right? Like what are the top 2 or 3 that you're really gonna hone in on? I'd love to hear those ideas in the comment section below. And then like this, share this with some other people who need to hear this stuff, because they're playing, they're rolling the dice, playing some speculative real estate, and you don't want anything bad to happen to them. Make sure that you share this with your friends, everybody else who's investing. And if there's anything that I can do, please don't hesitate to reach out. So please like, comment, subscribe, hit the notifications bell so that way you see all the other content that we're going to be dropping over the course of the next several months here. And take these insights, build a massive portfolio. I want to hear all about it. So appreciate you, love you, be your best.